Hey everybody, welcome back to the Optometry Money podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mindrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. If this is your first time, welcome aboard. And today's conversation, we are going to continue the theme of retirement plans in your practice. And I bring back last week's guest for part two of our conversation, Matt Ruttenberg, co-owner of Life Inc. Retirement Services, a third-party administrator. And now we talk about as your practice is progressing, as profit and cash flow is improving, and potentially as you, the owner, are getting closer and closer to exiting the practice. How do we really make the most and maximize the retirement plans in your practice? We talk about the different structures and layers of these different retirement plans and how they fit together. We talk about different calculations and styles of profit sharing in a 401k plan. We talk about cash balance plans and the huge opportunity to invest and put away dollars at a tax-advantaged way. And we wrap up with talking about how having two different entities, two different practices under common ownership impacts your retirement plan. Again, Matt brings so much experience and insight to this conversation. It was a pleasure to have him on. And we'll put all of Matt's contact information, all the other links and information mentioned in the episode in the show notes, which you can find by simply scrolling down in whatever app you're using, or by going to my website, optometrywealth.com, and heading over to the Education Hub. And while you're there, feel free to schedule a no-commitment introductory call, and we can talk about whatever's on your mind financially, and we can talk about how we help optometrists all over the country navigate cash flow decisions just like this and so much more. And if you're not ready to chat, that's okay. For my optometry listeners, I am offering a free financial health assessment, which you can find by clicking on the link in the show notes. That's just downloading the financial planning app I use with clients and for myself, entering in the information into your financial scorecard, and I'll send you a free video summary talking about what those scores mean for you. And without further ado, here is my conversation with Matt Ruttenberg. And welcome back to the Optometry Money podcast. I am your host, Evon Mindrin. Thank you so much for listening once again today. And in today's conversation, I'm going to continue last week's episode's discussion on retirement plans within the business. And in today's conversation, we're going to talk about how to, let's assume you're a more established practice, profitability is definitely increasing, you're looking for more ways to save on taxes, starting to get towards the highest marginal tax rates you're going to see in your career, and you're thinking about, okay, how do I start to put away 5-6 digits of dollars into these tax-advantaged retirement accounts? Today, I want to talk about how to really get the most out of your qualified retirement plans in your practice by adjusting and adding on these different features and layers into it. And to help me through that discussion, I brought back on for part two of our conversation, Matt Ruttenberg. Matt, thank you so much for coming back on.
Thank you, Evon. Appreciate it.
Yeah, and I to just follow into that introduction, right? We have a practice owner who's been in practice ownership for quite a while. The practice is humming along like many do. There's cash flow is quite positive. Tax rate might be the highest that they're going to see at the peak earning years of their career. And maybe even preparing for a practice transition, a sale of the practice in the next 5 years or so. How do they look at their retirement plan as an important investment lever? Yeah, but really as an important tax planning lever too, and really get the most out of it. How do they think about doing that? What's available to them?
Yeah, there's a lot you can do, and it's very integrated in between these in between the different kind of plans. And the best way I can explain it is through what I call it an upside down 3-layered cake. Okay, so if you picture, take a 3-layered cake, flip it upside down. These are the different layers that we're working with, and the bottom layer is the employee portion of your 401k, right? The $22,500 that we all know and love. That a lot of folks tend to think this is the only thing available to them in the 401k world. But then you have the middle layer, which we kind of touched on last week. It was the employer portion. So then you have the profit sharing, which gets you up to the $66,000 And I should take a step back on that. The employer contribution, which also includes the match that you're giving yourself
Right.
as an employee of your own company. Excuse me. But then there's another piece that a lot of people don't really know about. It's the cash balance plan, which is a form of a defined benefit plan, also known as a pension plan, right? So a lot of people thought the pensions went away with Ford and GM when they started buying out all these different pensions for everybody, but they're still around, and a lot of times it's for the small business owner, and they've softened on the rules on these things quite a bit, and this is where you really get into, I mean, depending on how it's all age based on the cash balance plan, but we have clients getting into $300,000 plus pre-tax contributions into
Wow.
these plans when you put them all together.
Yeah, and that's you think about pensions again, traditional pension. Well, this is sort of a light version of that. It's
Hmm.
sort of a bit of a stripped down version of the traditional pension plan that people used to be familiar with, I guess, that are not as common anymore. And as you mentioned, smaller, very more established practice owners or business owners in general are able to take advantage of these plans. So where should someone start? Let's say they've already started to max out their employee side of that, right? So they're taking advantage of that 22,500. They might have a match already. Maybe it's one of those safe harbor plans where it's somewhere about 4%. So they may have a match already in the practice. Where do they think about what to do next? What's
Yep.
next from there?
Yeah, and it's so that's exactly right. So we'll often get someone who's already maxing out at least one or two of those first two levels, and to max out every layer from the top down, you have to design the bottom layer to a certain degree, right? And so, for example, um, like I said, so we'll have someone come in and say, "Hey, I need more. I need more." Or a CPA will come to us and say, "Hey, we need more tax write-offs, and what else can you do?" And we'll take a look at their current plan. We'll say, "Okay, how is the bottom layer developed? How does that look? What does the match look like?" And for example, in order to maximize profit sharing, okay, there's something called a gateway, right? And a lot of people don't realize this. So there's a 5% gateway that you have to give to your employees, meaning everybody has to get at least 5% in the profit sharing. So there's different ways to design the profit sharing. So like we talked about last week, the SEP IRA, for example, is a very light version or a basic version of profit sharing, which is called pro rata. Whatever you give yourself, you have to give to your employees. But there's different things you can do on that. There's it's age based. Is a new comparability is another one, meaning how do we take that 25%, which is the maximum you can give to your payroll? Basically, 25% of your payroll is what you're allowed to give in profit sharing in general, right? As a big lump sum of money. How do we skew most of that over to you as the owner? That's where we get into these more advanced profit sharing designs. So new comparability, where you can, if you're older, you can give more money to the older business owner. So if you're older than your employee pool, that's great. We can do more with that. We can target certain individuals and say this is where we want most of this to go. For larger companies, you can drill down into departments and say, okay, well, the sales team isn't going to get any because we have a high commission rate, or we don't need to give any money to the laundry staff or the janitorial staff, things like that. You can segment out departments and not give them, they're not eligible. So you can actually discriminate in these profit sharing, different types of profit sharing. And to design the bottom layer is very important to maximize that middle layer. So safe harbors, for example, right? We definitely want a safe harbor for the bottom layer. We want to max out that 22,500, but then we have this 5% gateway that you have to give everybody at least in the profit sharing, regardless of how you're calculating it.
And
But
that's specifically the profit sharing. That doesn't include the match part of that. Is that correct?
so uh so that correct. Yes, that's specifically the profit sharing. Yes.
Okay.
But it does have a little bit to do with the match. So, for example, let's say you're given like a 4% match on this safe harbor, like you said. you still have to give another 5%
Got it.
to the
Okay.
for the profit sharing.
Uh-huh.
But if you choose the non-elective instead of the 4%, you do non-elective, which is a 3% contribution to everybody who's eligible that goes towards the 5%. Now everybody only needs to get two,
Interesting.
right?
So
So
non-elective meaning it doesn't matter whether your employees contribute or not. You're going to give them that flat percent of their income, regardless
exactly.
of whether they participate. But
Yeah.
if you're trying to, most people I think would sort of balk at that and say, I'm not going to do that. I want my employees to contribute and sort of earn that as part of their compensation for adding to the plan. But you're saying, hey, if you're really trying to get the most out of this profit sharing, this second tier of the cake,
Mhm.
that flat percentage is actually in your benefit.
Yeah, and at the same time, it depends on the company. Like if you have a lot of times, if we go into it's a smaller company, usually is what that works for, like under 10 employees. That works great. Larger companies, it tends to be a little bit more of a risk, right? Because you go into this designing these plans one way, and you're going in blind sometimes to say, okay, what's actually going to happen? Who's going to actually contribute? Who's not? And doing it to the non-elective gives you a peace of mind knowing what's going into it because you know
Uh,
who's eligible ahead of time.
yeah.
But at the same time, usually we're doing these with established plans for the most part, and we know what's actually happening already. So we have these conversations where, like, some people might say, "Well, you were giving me a 4% match before. Why are you bringing it down to 3?" And they'll say, "Well, we're giving you more in profit sharing. It's going to be profit
Mm,
sharing instead." Um, and then at the same time, there's the vesting is relatively short in a safe harbor, 2 years maximum vesting schedule. Profit sharing, you can drag that out to 5, 6 years. So you can have a different vesting schedule for the profit sharing than you do for the match or
mm,
the non-elective contribution. So that's just one way to maximize the second layer by designing the first layer properly.
got it.
Okay.
Got it.
Now we bring in the cash balance plan, which kind
Yeah.
of just screws everything up. Okay.
But
Uh,
before we go there, I
yes.
guess just to sort of summarize what we talked about, right? You have that bottom layer, which is the employee, you as the employee opportunity, which is 22,500 in 2023. And then on top of that is the employer layer, which is going to be that match that you mentioned, plus the opportunity to do profit sharing. And the total combined that you can get into these accounts with those two layers combined is 66,000 in this year, plus additional amount if you're over 50. But that's sort of that max top amount that you can get in these first two layers. And as Matt, as you mentioned, that there's different ways to calculate that profit sharing, often to benefit the practice owner, because ultimately this is going to be a tool for the practice owner. Yes, they may want to share their profits with the employees. This is definitely a way to incentivize employees to stick around and to feel like they're getting some value from their work financially, anyways.
Hmm.
But in a lot of cases, this is going to be for the practice owner from a tax planning and investment perspective. And it sounds like there's different calculations to benefit the practice owner most, even though you do have to share that with all employees. And as we talked about last week, this is usually for me a conversation at the end of the year between the administrator of the plan, which Matt, you would be an example of that, but the administrator of the plan, the tax professional, and myself trying to say, okay, what is our tax planning need? Let's project out taxes. What is our available profit sharing? And does it make sense to do that? Knowing we have to contribute to employee accounts versus just building up a taxable investment account. But those are those two top layers combined. And now you're saying, okay, there's this third layer, which is this cash balance defined benefit plan, cash balance pension plan. Talk to us about that. What does that
Yeah.
look like?
So this is when it gets into it kind of everything I've spoke about is important,
Yes.
but it kind of wipes out a portion of that. So you still want to have the non-elective contribution. I don't say you have to, but it does help. Okay, quite a bit. Now, there's another gateway, um, going up to the next level, and I wouldn't say it's a gateway. It's more of a maximum. So in order to max out your cash balance plan, the maximum you can give yourself in profit sharing is 6%.
Okay.
So all of a sudden, we just talked about maximizing your profit sharing, but now we're capping it at 6%, right?
Okay. Okay.
But that's okay because then you're putting the mass majority of the money that you lost back into the cash balance plan. So, I said 22,500, you're still going to max that out. But then instead of getting you up to the 66,000 in the second layer, you're going to be minimized. You're not going to get that much into the what is that, 43,500 or
Right.
something.
Right. Right. Right.
So you're not going to be able to put that much into the middle layer. It's going to be much less than that. But then the top layer is where you're going to get into the well into the six digits. If you're approaching retirement, you're looking at you can get up to 300,000 or more into there.
Wow.
If you're in your 50s and 40s, you're looking into the six digits. You're capping into the six digits and so on and so forth. So this is a little bit different. It's age-based versus where it's considered a defined benefit plan, which means you have to bring in an actuary. So the bottom two layers are defined contribution plans. You're defining how much money is going into it. The defined benefit plan is we have to bring in an actuary to calculate all these numbers because you're promising a future value versus how much you're putting in now. So it's more of the actuary is going to tell you how much you can put in based on a number of variables that I've tried to guess many, many times, and I've been completely wrong every single time. But it's based on age, it's based on like how long the company's been around, it's based on your employee pool, it's based on X, Y, Z, everything else under the sun. So we do a lot of these numbers. We run a lot of numbers to make sure we have an accurate, and the actuaries have to sign off on it to be able to do that because it's extremely regulated to the point that where they define the interest rate that you have to target inside of this. This isn't something you can just throw into a certain index fund or something like that. You actually have to target this because you have to stay on that promise for you and your employees. And you are an employee of your own company. So
Right.
you are promising yourself a future number.
Right. Which not only impacts the amount that you're putting into the plan, but the how it needs to be invested.
Exactly.
Right.
Exactly. Yeah. You can't go full bore into the risk, maximum risk tolerance. You could, but what would happen is it actually minimizes how much you can put in the next year if you put too much in, right? You have to maintain this target. And then on the flip side, if the market does go down and you don't reach the targeted rate, you actually have to put in more to ante up, basically. So you want to keep it relatively balanced and so on and so forth.
Yeah. And this, when I think about that, there's a lot of factors here, right? There's the tax planning opportunities, right? Because you mentioned depending on the age and I
Mm-hmm.
guess the makeup of the employees, depending on age of the owner, you're looking at six digits potentially of deduction opportunity by putting money into this cash balance plan.
Mm-hmm.
100,000, 200,000, depending on, of course, the age of the owner, the makeup of the employees, and everything that goes in that calculation. So you have a significant tax planning opportunity, but you also need to think about the lost potential growth opportunity of not being able to invest in a way that's appropriate for your stage of your career, right? So there's offsets. There's offsetting factors that you do need to think about too. Who is this cash balance pension plan appropriate for? Like, how would you sort of weigh
Yeah.
what type of business, what type of practice owner this makes sense for?
So we get great question. So the ideal scenario is someone who's older, much older than their employees, and just has a few employees, right? For example, there's a couple clients I can think of right now that they're approaching retirement. We're able to put in $350,000 total into the plan, and the employee maybe got $1,500 or $2,500 into their cash balance plan balance, and that's got its own vesting schedule, just like the profit sharing. And but now when you do that, your employees, most of the money that they're going to get is going to be in the profit sharing part. Okay.
Mm.
You're going to max out your cash balance plan. They're going to get a very small percentage in the cash balance plan, and then the rest of it will go into the profit sharing plan. So it's a little bit different. Again, different on that one. The other thing we see is a lot of very high income independent contractors.
Mm.
So those who are maybe even like the surgeons, where they're making quite a bit of money, but they're a 1099 contractor jumping from hospital to hospital to hospital. Um, and income is growing across every industry these days. So uh, the least amount of employees, the best. But like everything in business is net. Everything that we talk about is net, 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 net. What's your net income? What's your net cost? What's your net taxes? So there's going to be a cost associated with any retirement plan to what is your, what are you going to be in the black? Are you going to be in the red?
Right.
And when we do these, excuse me, these analysis on uh, on running these numbers on these three layers, we'll always tell you if you're going to be in the black, you're going to be in the red. If you're in the red, this is pointless.
Right.
And then sometimes it's too much of a headache to worry about if it's just a little bit. But for the most part, you're going to be substantially in the black. And usually it's if you have just a few employees, it's not ideal if you're the youngest in the company. If you are the youngest and everyone else is older, or you have quite a few that are nearing retirement, maybe staff or something, then sometimes that can hurt you because you're going to give them a substantial amount.
I see. It would not benefit you as the owner nearly enough
Right.
to make that worth it. And so age is important. Again, like you said, the age is important because you're ultimately trying to solve for a future benefit.
Mm-hmm.
And in theory, the older you are, the less time you have to save for that benefit based on their assumptions of return over that time. So that allows you to put more into it. And if your actual returns are higher than this sort of targeted rate, that means you're able to put less in because your returns are carrying you closer to that future targeted cash balance amount, benefit amount. So age is important there. The younger you are, the more time you have to invest. It's just like if we were to plan for, I want to save for X goal 20 years from now. Okay, we can sort of think about how many years are left, how much you have to invest, what sort of range of returns might we expect. And that kind of tells us, okay, this is how much you need to save in order to get there. This kind of takes that same theory and applies it to figure out, okay, how much can you put into this plan? So age is important there. Cash flow of the business sounds like it's really important. Is there
Very important. Yeah.
a requirement for how long you need to? Because like you mentioned, a profit sharing in those defined contribution accounts like the 401ks, profit sharing is sort of discretionary. You can turn it on 1 year, you can shut it off another year. Is there an amount of years that you need this cash balance plan to stay in force and continue it to make sure it's legitimate?
Yeah, this is one of those rules that I guess they've softened on quite a bit. A little, in the past, it was pretty stringent on any defined benefit. They want 3 years, and 3 years I think is a fair number to say. They want 3 years. However, you can pause the plan. That is an option. You can pause the plan. So if you feel like, if you have a year that is just completely out of the norm and it's substantially higher than what you think the next year is, don't do this. It's gonna hurt you. But if you have a foreseeable future of a much higher income than what you're used to, this would be a very good idea, and you can pause it if you need to. And we have pause plans before.
Yeah.
But 3 years is usually, if you don't think you can do 3 years, I think you should walk away and do something different. And you mentioned cash flow is super important. I mean, cash flow, September 15th is when these are due for the previous year. Okay, you still have to do I mentioned this in the last episode. Any employer contributions the deadline is when you file your taxes, including extensions for the previous year. Okay, because this is this is considered an employer contribution. However, the deposit for a cash balance plan has to be done by September 15th, regardless of how you're filing. If you're an S corp, if you're a single member LLC, however it is, but it's always September 15th. And cash flow, believe it or not, ends up being a barrier. Because when you're going to deposit 300 grand into a cash balance plan, sometimes it's hard to pull that extra cash up, right? Inside of these are employer contributions, so it has to come out of the business, right? So that ends up being a barrier to implementation is if you feel like you can get to that by September 15th. And if it's going to cause any sort of disruption or liquidity issues, if you can, because again, you want to make sure that you have 3 years. So we've implemented these, and then all of a sudden they get a little panicked because the next year, like the first year is great, easy, all the cash is in, we're ready to go. Can you do it the next year? And then the next year after that. And if you can, these are phenomenal plans. But if you feel like there's going to be a cash flow issue, you have to time it out. You really have to time it out.
Yeah, I think that window when we talk about or you the listener as a practice owner, you might hear, there's a window of like 3 to 5 years before, if you're thinking about selling your practice, there's sort of a window of like 3 to 5 years where you can plan for that in the business. In the business, prepare your business for that, prepare your own life financially for that, but also prepare for the tax that's likely to come at the sale of that business. Depending on how that sale is structured, as an asset sale, for example, you're going to see capital gains, and some of that's going to be a depreciation recapture. So there's a tax hit that's going to come when you sell that asset that you've built up all these years. So using something like this can help you lower your taxes as you lead up to that, and then in the year of sale, you can benefit from this plan as well. So that's something to keep in mind if you know that there's sort of this window between now and leaving your practice. That 3 to 5 year window before that is important for a lot of reasons. One of which is you can start to prepare more proactively for that tax that's bound to come. How do they determine the percentage that they're targeting as a growth rate? And tell us about like how the actual returns of the portfolio sort of impacts that a little bit more.
Yeah. So just for an example, the actuary might use, like prime plus something or prime plus one or prime or whatever it is. So as an example that they might do that. So let's just say 5-6%. Historically, now interest rates have gone up a little bit, so that's going to adjust as you go. But yeah, so I mean that needs to be like a decently balanced portfolio where you're not trying to, beat the market at all by any stretch of the imagination.
Right.
And again, like I was mentioning earlier, like if you miss the target, the next year the actuary is going to say, okay, you missed it by 1 or 2%. That needs to go into the plan along with your next year's contribution. And every year that you get older, the more you can put into it. And you have to think, okay, do I want to max this out, or do I need to adjust this a little bit from year to year? And every time you make that decision, the actuary needs to make the changes. So it's this ongoing conversation. So when like you mentioned, 3 to 5 years, right? And don't whenever, just a side note, whenever you're buying or selling a practice, for example, don't ignore the 401k plan. There's so many things you can do inside of the 401k plan when you're purchasing it. You can tell them, I want to start with a brand new plan. I want to use those. If you're buying, a business where you're going to maintain the staff, are you letting go of the staff and rehiring them under your new entity, or are you taking over the entity? Those are things that you have to think about. But when the plan is in force, the actuary has to be involved. Okay. When you retire or close to retirement, you simply shut down the plan and roll it into the 401k or other qualified plan. As long as the plan is in force, the actuary needs to be involved. So those are costs that you have to think about moving forward as well. And anyway, that's something that you actually have to think about. Like, this isn't a traditional pension plan like Ford, where they're buying out all these different employees' pensions, like where they're offering these substantial amounts of money to buy out their pension, because I can't imagine the cost of the actuary that they had to pay in order to keep this plan going, even though like the new employees weren't getting the new pensions, so they're trying to buy out all these pensions, and every time they buy somebody out, it's a little less out of their pocket every year after year after year. So the goal is to shut the plan down when you're done.
Got it. And so in theory, you can go those 5 years or so, like to satisfy the requirements of how long it needs to be open, benefit from it through all the cash you're able to put into it, and then shut it down to sort of remove the role of the actuary being involved in your life.
Mm-hmm. And then invest it. Yeah.
roll it into either the 401k or a traditional IRA, out of that cash balance plan into another retirement plan.
Exactly.
And in theory, can you go a few years and reopen that cash balance plan? Like, how would that work?
Oh, sure. Yeah. If you want to shut it down for a few years and then bring it back into, yeah, absolutely. The only thing that you're going to be against is, implementation costs and things like
Got it.
that.
Got it.
Again, you don't want to shut it down after a year. You want to go to 3 years. You can pause it and then, for a year and go back and do the other two if you want to do it that way. And you can do that within the 3 years. We've done that many times, usually for cash flow purposes, like they're not able to do it. So you pause it. You're still paying the actuary because they're still crunching
Yeah.
the
Yeah. Yeah.
numbers and
Yeah.
things like that. But it could save you as far as the contributions are concerned. But yeah, I mean, you can shut it down, come back 5 years later and do it again. And as soon as you take it out of the cash, all those target rates that you have to go after inside of the cash balance plan, as soon as you roll it into the defined contribution plan, which is 401k or even an IRA if you wanted to, the investment world expands quite a bit on what you can invest in.
And in terms of those costs, like what does the actuary cost actually look like? What does that look
Yeah,
like in
you-
dollars?
you're going to be looking at it's in a couple $1,000s. It's
Okay.
about $3,000 to $4,000
Per year?
per year
Per year.
to implement a cash balance plan, and it's purely the mass majority is the actuary. Actuaries are very expensive to deal with, but there's a lot going on, the liability, and they have to sign off on it. But that's what you can expect.
Got it. Okay. Because we talked about the profit sharing, we talked about this cash balance plan. I mean, how does a business owner figure out like what works for them? Like how, if they were to talk with you for the first time, would they give you like a census of their employees? Like what do they need in order to figure out
Yeah.
like what makes the most sense for them?
Yeah, and honestly, the census is absolutely number one. What we have to do because it lines up with, and this is gonna be different than using your group health plan. It's a little bit different. But all we need to know what's the relation, what's their hire date, their tenure with the company, what department are they in? Because can we segment out some people? Do we have to target? Who can we target? Are they related to the owner? And we have templates that we pass out to folks to send it back to us, and then we run the numbers, and that's simply it. We don't. There's no cost to run numbers because you have to run the numbers for it to make sense. We're not going to sell you a cash balance plan and then all of a sudden say, well, this doesn't. You're going to be in the red for the next 3 years.
Right.
Sorry.
Yeah. Yeah.
So no, we run these on a regular basis because it is absolutely vital to see if it makes sense. And usually it's a simple printout. Even if you have a payroll provider, it's an easy, it's the same as the 401k. If you have a 401k census template, it's the same thing that we're working off of there.
Yeah, I like how you describe it as sort of this three-layered cake, right? You can start from the bottom, fill up each tier, and then say, okay, I'm ready for the next year or I'm not.
Mm-hmm.
But either way, there's a substantial amount of opportunity to save on a tax advantage basis using these retirement plans in the practice. I mean, there's a huge opportunity here, and for the 401k side of it, it can be Roth, it can be pre-tax, but if you're thinking about using the top two tiers to their fullest, you're probably at the highest tax rate you're going to be seeing throughout your career, and it's usually where you're able to, or you want to start thinking about how do we get the most deduction as possible. I guess another thought I'm just sort of thinking out loud is if you're going to be in this situation where these plans make sense, is something you might hear in conversations a lot with optometrists is that you have 4 more years of schooling, maybe you go through a residency, so that's 5 extra years of schooling or plus residency, and you're sort of behind the 8 ball in saving and growing wealth, and you've got student loans to deal with. But if you're going into practice ownership opportunities, there's sort of ways to catch up, like using these different tiers. Like even though you were sort of behind the 8 ball a little bit initially, or at least you might feel that way, there are ways to catch up by higher opportunities to save in these plans, especially as you get to 50 and older. You're able to use the catch up additional amounts. So there's opportunities to use this extra cash flow you're getting from these practices to really start to fund these accounts heavily and build them up. One thing I wanted to ask you, Matt, is it's not uncommon for practice owners to have different locations, right? So they've
Hmm.
got their primary practice, but they open up another location in another town nearby, or just other businesses that they're working on the side. How do those other locations and those employees in that practice, like how do they factor into these retirement accounts?
Yeah, no, great. That's a great question. So, and this is common, a lot more common than people think with, expansion of entrepreneurship and so on and so forth. Um, so a second location is it's absorbed into the plan. It's,
Okay.
it's still under it's the same entity. That's a normal practice where it's still under the same 401(k) plan. Now we get a lot of I guess serial entrepreneurs, or well, they're owning multiple businesses. Um, some of them are even doing real estate on the side, and they want to know, how does that connect? What can we do here and there?
Yeah. Well,
Um,
I guess an example of that would be an optometrist owning a primary care practice and then opening up a specialty contact lens practice. I've had a conversation with someone on this
mm,
podcast who's done that, separate entities, same ownership, right? He's the ownership of both practices, but different specialties. One's primary
yes.
care, one's a different specialty.
Yeah, no, great. So what we're dealing with in this is a controlled group, right? And the controlled group is an IRS rule that is needs to be taken very seriously, right? We get a lot of people calling in and it's like, how do we get around this and how to get around that? And first and foremost, they're always going to lean towards the employee. 100% they're going to lean towards the employee. It's everything about the 401(k) world is fairness to the employees. So there's a lot of different rules when you're deemed a controlled group. Okay. And a controlled group is, in this instance, the one that you just mentioned, it's common ownership, right? This individual owned 100% of both businesses. And because of that, the IRS looks at that as one company. You cannot you can't have one company enjoy the 401(k) and then the other company with employees as well not.
Mm.
Okay. You have to consider it as one. You don't have to have two. You can have it as under one, so it's going to help you with administration costs. Some of these turnkey 401(k) programs online are going to say, no, you have to have one and you have two. I can think of a few right now where they can't have multiple bank accounts simply feeding in, because that's basically what you're doing. You're taking one bank account from two different companies and feeding it into the same plan.
Mm-hmm.
It's a simple technology issue. Um, but in that instance, yes, you have to have whatever you offer to one company, you have to offer it to the next.
Okay.
Okay. So if you have profit sharing plan on one, you have to offer it to another. If you have a cash balance plan on one, you have to offer it to the other. Um, one thing that we see a lot in the medical industry, um, is it's not, a percentage. 50% ownership is a key, right? So if you own 49% of another company and 100% of one, you do not have to offer it to the other one. 50% is that key. Okay.
Okay.
Um, but there's one that everybody overlooks. It's called the affiliated group.
Okay.
Okay. It's an affiliated group. And we see it a lot in the medical industry. So, for example, let's say you have um, uh, primary, it's a primary physician, right? Primary care office. And then they open up, in this instance, a contact lens business. If the mass majority or all of the income going into the contact lens, the second company, is coming from the main company, the primary practice, that is an affiliated group, and
Okay.
it is also considered a control group, and you have to offer it to both companies. So we see that a lot. We see that a lot.
So that would be literally revenue. So that would be if you have this primary care practice is paying the specialty contact lens practice for providing services to the primary care practice's patients. Like, is that essentially what you have in mind?
Exactly.
Okay.
Exactly.
Okay.
Yep. Yeah. And so it's revenue. And then, like, think about it this way too. So, also in the medical field, partnerships, right? There often we'll have a group of physicians to whichever specialty it is. So we'll have like four or five physicians, and they're all 20%, 25%.
Right,
So
right, right.
you're looking at that, and then they open up their own LLC, and the money's flowing to each one of their LLCs, right? But they only own 25% of the parent of the group. So one might think that's not 50%. It's not an affiliated service group. I can just do a solo 401k, do all three tiers under my LLC because I have no employees and all the money's coming to me. That is 100% a controlled group because 100% of your revenue is coming from the parent group. We see that as an issue all the time. Sometimes we get the earmuffs and they don't want to hear it. They don't want to hear our rule. At the end of the day, an ERISA attorney is the one who deems these yes or no, and that's who's going to have the liability. Folks like me, folks like other companies, record keepers, they're going to give you advice. But at the end of the day, an ERISA attorney is who you need to consult with that. But that is an affiliated service group to the nth degree, and it is absolutely a control group. You're going to have to offer it to the employees of the physicians group.
How do family members play into this? Because you might have a husband and wife that together own one practice. Maybe the husband owns that second practice, that second entity. Like how does family play into this, or more seasoned parents and their child is now in the practice as owner? Like how does the family work with that?
Yeah, you can use that to a benefit or not, honestly. And we've pulled in control groups. We've turned them into a control group, even though like
On
you
purpose.
could probably on purpose.
Oh, okay.
And usually it's because like someone who owns 3 or 4 companies, they don't want to have to pay administration fees and the costs for all of them, so we just do it under one. But spouses are interesting. So if you had, so you could technically separate them. Okay, so if it's spouse one, spouse two, right? One is 100% ownership, 100% ownership, 100% ownership on each. They are not owned by each other at all. Okay, it is a controlled group if a spouse has a very in-depth managerial role in the other company.
Okay.
And that would be that you could use that as a controlled group. And we've done that with cash balance plans specifically because those are expensive. And to try to minimize those costs, we could have made that a control group or we could not have. That could have gone either way. So you might have to shift your role in your company, in your spouse's company to make that work, or remove yourself from that role to make it work.
So not just being the only optometrist seeing patients in that entity, but literally there needs to be a management role. Right?
Yeah, you have to have a very substantial role in that company, like you're running the books or you're managing the staff or something like that, to make that be a part of that. Yeah.
Okay. Interesting.
Yeah, so we've told people there's too much of a role going on here. This if you get audited, this will be a control group. Those are a little bit harder, like I wouldn't say to prove, but those are first and foremost is the 50% rule. Second is the affiliated service group, and then we'll say, okay, well, if we can't do that, how about this? How about the spousal piece of it? So we've done that a number of times, where we have to dig into. Does this work? Does this work? Does this work? Does this work? And there's a few others too, usually for larger entities that we have to worry about. But yeah, you can use that as a benefit, or it can hurt you.
Yeah. Well, that's fascinating. I guess if for the listener, if you're thinking about making an entity decision, whether it's purchasing, whether it's opening, whatever it may be, among the list of people you should be consulting with, your tax professional, attorney, financial planner. Talk with your plan administrator to see what is this going to do to this plan, and what do I need to do. Just make sure that's not something that's missed. Make sure that person or business is on the list of people you want to talk to.
Yeah, and I do want to jump in on that. Sometimes you want to double check what you're hearing for sure, because we've had folks go to their CPA and it's an incorrect. The administrator is absolutely the best person to talk to.
Yeah.
SEP IRAs, simple IRAs, do not wipe out the control group rules. I've seen this many times where someone will say, if you just do a SEP IRA, you don't have to worry about the control group rules. Some will say they think the control group rules only apply to 401ks. That's 100% inaccurate. It's always intact when there's employees, regardless of
Interesting.
what kind of
Okay.
plan you have. Okay.
Okay. Regardless of what. Okay. Interesting. That's good to know.
Yeah.
Yeah.
Yeah, because that I've seen that to where there could have been a big issue, and we've had to fix a few things. So, um, yeah, that's something to really look into. Is the control groups are interesting.
Yeah. Well, I think that's fascinating. I mean, we've talked about a lot today. We've talked about trying to get the most for those more established practice owners, trying to get the most out of these retirement accounts as you can. We talked about what some things to think about if you own multiple entities, or if you
Yep.
and a spouse or family member owns multiple entities. What are some last things that you want to leave with practice owners as they think about, okay, how do I review and look at and make the most of my
Hmm.
retirement plans for me?
Yeah. Yeah. First and foremost, uh, before the end of the year, do income planning with a financial planner, a CPA. Income planning is really, really important because as soon as 12/31 comes around, your income's done, right? There's not much you can do. So when I say income planning, it's let's come up with a plan, not the last week of the year, but a lot of this is a lot of solo entrepreneurs where they'll say, how much more do I need to cut? Do I need to cut myself as far as my W-2 or whatever, so I can maximize this, and this?
Yeah.
Do it ahead of time. Start a month or two ahead of time and really say, okay, when or how much do I need to pay myself in order to max out these different plan types? And then two, again, sometimes it takes 18 months to implement a plan when we talk to people. Start the conversation, just because it's a vast world in order to really understand what's available. I do my best to not give all the options. When I speak to someone, I talk to it's what's relevant, what's not. Some people want to hear all the options, but getting to an understanding of what's available to them and planning ahead is such a important. It could be years before you know what's available, but just ask the questions.
Right.
It is
Right. Right.
absolutely vital to understand. So you have just like you have a 1, 3, 5 year plan on your business. This is a part of it,
Yeah.
and what is available, and because you might be able to do something earlier than you think.
Yeah. Well, I love that. And that income planning is so important really for a lot of reasons. I mean, a lot of the practice owners listening will probably be taxed as S corporations, and
Hmm.
typically are going to want to lean on their salaries being lower for tax
Yeah.
purposes. But there's a lot that goes into it. It's not just employment taxes. It's not just that QBI deduction. It's what do you need to sustain your desired lifestyle, and what's the best way to pay for that in the
Mhm.
household. What do you need in order to maximize these different retirement benefits that are available to you? So there's more than that. There's more in that decision of how much to pay yourself than just how do I lower my employment taxes.
Yeah, that's big because when you're an S corp, um, like you said, the goal is to lower those taxes, right? So you pay yourself a lower, especially when you're transitioning from one to the S corp.
Right. Right.
Everything in the 401k world, employee contributions, employer contributions, is based on your salary that you choose to pay yourself.
Right.
So if you shortcut, if you try to make it as low as possible, it's going to affect your employer contributions for sure.
Yeah. Well, this has been a lot of fun, Matt. How can people find you, follow you, learn more about what you're doing?
Yeah, I'll give you a lot of the links, the tax credit links that we've talked about before.
Yeah.
Our website is 401k.expert. We're on all the social media platforms as well. LinkedIn, Facebook, Twitter, and then to find us is 401k.expert. Right on the top, we have the tax credit calculator on there. We also have an evaluator tool that I can send out to you that will, those two questions, like what is your goals, what is this, and it'll narrow down which kind of plan is best for you. We have explainer videos and quick guides and all sorts of stuff that we can share with you guys. So, and obviously just reach out to me. you can reach out to me. It's I'll share my email address. It's a little bit long. My last name is long, so that way you can have that.
Yeah,
and I'll obviously go through Evon. He can introduce you to me as well. I can do that too.
I will put all of that information in the show notes. And again, appreciate your time. I definitely appreciate, and hopefully the listener can appreciate just how valuable having you and your peers in our corners to figure this out. I mean, you're not just an expense, you're an investment to make sure these things are done right and it's used to their full potential, just as useful as bookkeepers, as tax preparers and professionals. So I appreciate your insights here, and all of your information will be in the show notes. In the meantime, for the listener, really appreciate your time and listening today, and we will catch you on the next episode. Take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mindren is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.